All right, welcome to the deep dive. We got some great questions from you guys about like all the different kinds of life insurance out there. And yeah, I get it. It's a lot. There's so many terms and types. It's easy to get lost in it all. So today we're going to like really break it down for you, make it clear, insightful, We've got tons of information here, so consider this your shortcut to knowing all the essentials without getting bogged down in like the insurance jargon. I think what's really surprising when you start looking into this is just how many different types of policies there are and how they can be tailored to like very specific needs and situations.
Yeah, absolutely. And I think one of the first things that you realize is that it's not just like one basic kind of life insurance, right? There's a whole spectrum, and each one is designed for, different needs, different stages of life. So we're going to start by talking about temporary protection, which is what term life insurance is all about. Then we'll move into the more permanent solutions, focusing on whole life as kind of like the foundation there. And then we'll get into some of the more flexible, non-traditional options. We'll touch on those with an investment angle. And finally, we'll look at policies that are designed for very specific situations.
Okay. So let's start with that temporary protection with term life insurance. And all our research points to term life as being great if you want potentially a higher death benefit at a lower cost, at least initially compared to permanent insurance, right? The core concept here is coverage for a specific period. That's where the term comes in. So like if something happens within that time frame, there's a payout.
Yeah. Exactly. It's all about protection for a defined period.
Yeah.
And if we think about like, when is this useful? Well, often it's, when you're raising a family or if you've got a large debt, like a mortgage.
Right.
The example here in our materials is Steve. Steve's got a 20-year level term policy. So if he passes away within those 2 decades, his family gets the benefit. But if he lives past that 20-year mark, the policy just expires. Because the temporary need for like that specific coverage has probably passed, right?
Yeah. Makes sense. Now, within term life, there are actually several different types of policies. So let's start with maybe the most common one, level term. The name kind of gives it away, right?
It does. Level term means you get consistent coverage. Your premiums stay fixed throughout the term. So it's really predictable. You could choose, for example, a 10-year policy. Gives you a decade of steady protection. Or you could go for a term to age 65 policy. And that'll cover you until you maybe retire and your finances change. But either way, the amount your beneficiary would get stays the same. And I think there's even like an exam pick here. If you see a question that just says term policy and it doesn't specify the type, you can usually assume they're talking about level term.
Good tip. Okay, then there's increasing term. And as the name suggests, with this one, the death benefit actually goes up over time. It can be like linked to inflation, or maybe your income is projected to grow. At least that's what I'm getting from all this. So how does that actually work in practice?
Yeah, it's designed to keep the real value of the death benefit, current, or to match like your increasing financial responsibilities. So there's an example here of a physician, and their policy increases by like $100,000 every 5 years until they reach age 60. So as their income grows and, potentially their financial obligations, the coverage increases too. But one thing to keep in mind is that the premiums for an increasing term policy are probably going to be higher right from the start compared to, a level term policy with the same initial death benefit. You're paying more upfront for that built-in increase.
Makes sense. Okay, now we've also got decreasing term, and this is where the death benefit actually goes down, right? But the premiums stay level. That sounds a little counterintuitive,
It does. Until you think about the specific needs it's meant to cover. If you link this to like financial obligations like a mortgage, it starts to make a lot more sense. So mortgage redemption insurance, which is a great example from our materials. As you pay down your mortgage, right, the amount of coverage you actually need to pay it off if something happens also decreases.
Yeah.
So that decreasing death benefit lines up with that decreasing debt. And it often makes it a very cost-effective way to make sure your family isn't burdened by that specific debt.
Right. It's a targeted protection. Okay, and speaking of debt, there's also credit life insurance. And this one is, it's designed to specifically pay off a loan balance if the borrower passes away. So who benefits from this kind of policy?
Well, usually the lender's the beneficiary. And just like with that mortgage insurance, it functions like decreasing term because the outstanding loan balance, typically decreases over time. Now, there's also an important point our sources make about protecting borrowers. So like a lender might offer or even require you to have some kind of life insurance as a condition of the loan, right? But they can't legally make you buy credit life insurance from them specifically, or even from like a company they choose. It's actually against the law.
Good to know. So we've covered a few basic term types, but things get a little more interesting with convertible term. This sounds like it offers some flexibility down the road, right?
It does. Convertible term gives you this great option. You can exchange your temporary coverage for a permanent life insurance policy. And the best part is you don't have to go through all the hassle of proving your insurability again, which is a huge advantage if, your health takes a downturn during the term of your policy. Now, there are two main ways our materials say this conversion can happen. One is attained age. That means the premium for the new permanent policy is based on your age when you convert. The other is original age. That means it's based on your age when you first got the term policy. So what are the trade-offs here?
Well, I'm guessing with original age, the premiums on that new policy are going to be lower, but I bet there's a catch, right?
You got it. You usually have to pay the difference between what you would have paid if you'd started with a permanent policy from the beginning plus interest. It's a bigger cost up front, but the advantage is that your future premiums are lower. And potentially your cash value grows faster in that permanent policy. Oh, and another exam tip. If they don't specify the conversion method, you can usually assume they're talking about attained age. Also, there's this thing called interim term insurance. It's basically a short-term bridge for someone who needs like immediate coverage, but they know they want to convert to a permanent policy soon.
Interesting. So moving on, we've got renewable term. It's kind of like convertible, but instead of switching to permanent, you just keep extending the term of your current policy, right? What's the catch here?
Well, you can extend your coverage without needing a medical exam, but your premiums are going to go up each time you renew based on your age. They call this a step-up premium. So you have that continued coverage even if your health isn't so good anymore. But our materials point out that it can get really expensive over time to the point where it's, maybe not even affordable anymore. Oh, and some policies give you both options. You can renew and convert. It just gives you more flexibility.
Gotcha. Okay, then there's annually or yearly renewable term, AYRT. I'm guessing this is like the shortest term option we've got.
Yep, exactly. Coverage is just 1 year at a time.
Mm.
But you can renew each year. And just like other renewable terms, the premium goes up each year as you age. Now, what's kind of interesting here is that you often have two different premium rates. There's the current or scheduled premium. That's what they're charging you now based on their costs. And then there's a guaranteed maximum premium. That's the highest they can ever charge you. So it can fluctuate up to that maximum. That's why they call it non-guaranteed level.
Okay, and lastly, in the term category, we've got re-entry term. This sounds good for people in good health.
That's the idea. So when it's time to renew, you've got a choice. You can renew at the standard rate, no medical exam. Or you can take a medical exam. And if you pass, prove you're healthy, you might get to renew at a lower premium. If your health has declined, you can still renew, but it'll probably cost more. So there's a chance to save money if you stay healthy.
So a lot of different term life options. And we've actually got this really helpful table in our materials. It summarizes all the key features of each type. Like, is the death benefit level? Are the premiums level? Does it build cash value? Are there loans or withdrawal options? And, most term policies don't have those things. It really makes it clear that term life is about like pure protection.
Absolutely. That table is a great snapshot of like the core purpose of term insurance. And we also have a clear breakdown of the main uses, the advantages, disadvantages. The good things are like really clear. Low initial cost makes it accessible. You can secure coverage now and think about permanent options later. Protect your insurability. It's perfect for temporary debts, and you get a lot of protection upfront for your money.
Yeah, but the downsides are important to consider too, right? It's temporary, those premiums can increase, and since the policy might expire before you pass away, fewer claims are paid out, and there's no cash value. So it's really about, meeting a very specific time-bound need.
Exactly. Term life is great for those specific goals, but it's not meant to be like a lifelong thing or a way to build wealth.
All right, so let's move on from term and get into permanent life insurance. The big one here is whole life insurance. It's supposed to provide lifelong protection, fixed death benefit, fixed premiums, and then there's this whole thing about cash value, which grows tax deferred. So how is this fundamentally different from, the term life we were talking about?
The big difference is that whole life is designed to cover you for your entire life. Guaranteed payout, no matter when it happens. So you get that little death benefit, predictable premiums, long-term financial security. And as you mentioned, the cash value is a big deal. It's like a savings account built into the policy.
Yeah.
And it grows over time.
And it's not just for the beneficiaries, right? I mean, the policy owner can actually use it while they're still alive.
Absolutely. You can access it a couple ways. You can surrender the policy and you'll get the accumulated cash surrender value.
Yeah.
But that ends your coverage, obviously. Or, and this is usually the better option, you can borrow against that cash value. It's called the policy loan. But keep in mind, those loans, they do accrue interest. There's an example here, John, who has a $100,000 policy. It shows how that cash value grows over time and how it offsets, the insurance company's risk over the long haul.
Now, I'm also seeing here that whole life policies are designed to mature or endow at age 100, or sometimes later, depending on the mortality tables they use. So what does that even mean for the policyholder?
Basically, what the insurance company is saying is that by that age, the cash value in the policy should have grown to equal the face amount of the policy, the death benefit. So it's like the policy is paid out while you're still alive. Obviously, most people don't live to 100, but it's just the way these policies are structured. It's the target they're designed to reach, mathematically speaking.
And the premiums, how are those determined for whole life insurance? They're described as bundled premiums in our materials.
Yeah, so unlike some other types of life insurance with traditional whole life, the insurance company doesn't have to break down exactly how much of your premium is going towards like the death benefit and how much is going towards cash value growth and how much is for, their expenses. It's just all bundled together. It's calculated based on your age when you get the policy, and it stays level for the entire time you have the policy. There's even an example here of the cost per $1,000 of coverage at different ages.
Okay. Now, just like with term, there are different basic forms of whole life insurance. So let's start with what seems like the most basic one, straight whole life.
Yeah, straight whole life is the simplest one. It's got those core features we talked about, level protection, level premiums. You keep paying those premiums until you pass away or reach age 100. And another exam tip, if you see a question that just says whole life and doesn't say what kind, you can usually assume it's straight whole life.
Got it. Okay, then we have limited pay whole life, and this sounds good for someone who, wants that permanent coverage, but they don't want to keep paying premiums forever.
Exactly. With limited pay whole life, you pay premiums for a specific period. Could be 10 years, 20 years, or maybe until you hit a certain age like 65. And after that, the policy's paid up for life. So yeah, the premiums are higher during that payment period because you're compressing the timeline. But the great thing is, your coverage is locked in. You don't have to worry about those premiums later in life, maybe when you're retired and on a fixed income. It's a good choice for people who want that permanent coverage, but want it all paid for by a certain point.
All right, and then there's single premium whole life. Sounds pretty self-explanatory. One big payment up front. What are the good and bad with this one?
Yeah, you make one lump sum payment. Policy's paid for life. It's a lot of money up front. But over the long term, it can be the cheapest way to get permanent coverage compared to paying premiums every year for decades. And you have that cash value immediately. But, it's a big financial commitment up front. Not for everyone.
Yeah. We've also got another table here summarizing the characteristics of these different whole life types. Again, looking at death benefit, premium structure, cash value, loan options, all that. It's interesting to see how they vary, even though they're all, whole life.
Right. The table really shows the trade-offs, especially with how long you pay premiums and how fast that cash value grows. It comes down to, your current financial situation and your long-term goals.
All right, let's move on to what they call non-traditional whole life insurance. Seems like these are mostly about, changing how the premium payments work. First up is modified whole life. So how is this different from straight whole life?
Well, modified whole life is meant to make permanent insurance more affordable, especially early on. So the premiums are lower for a set period, like maybe the first 3 to 5 years, and then they go up to a higher level, but that stays fixed for the rest of your life. It's good for people who don't have a lot of money now, but they think their income will increase in the future.
Okay, and then there's graded premium whole life. Sounds kind of similar to modified, but maybe a more gradual increase in premiums.
Yep, that's it. Instead of one big jump, the premiums start lower than traditional whole life. Then they increase over a certain period. Eventually, they level off, but it'll be higher than if you'd started with a straight whole life policy.
All right. Now, they also mention enhanced whole life here. Sometimes it's called economatic or extraordinary life. Sounds a little more complicated. Something about dividends.
Yeah, this was a little more complex. It's usually a participating policy, meaning it might pay dividends if the company does well. The interesting thing is the base face amount actually decreases each year. But any dividends you get are used to buy either paid-up additions, which increase a death benefit, or they buy one-year term insurance that offsets the reduction in the face amount. The idea is to keep the overall death benefit pretty stable, even though the base amount is decreasing.
Okay. Then there's indeterminate premium, whole life. This one seems to add some flexibility, but also some uncertainty about those premium payments.
Right, so it starts with a lower premium,
Yeah.
and then after a while, the insurance company can adjust the premium rate. They base it on like their investment income, their mortality rates, their expenses, but they can't go above a certain limit. There's a guaranteed maximum premium.
Okay, and then there's current assumption whole life, or CAWL. They also call it intersensitive whole life. This seems to be where the premiums and cash values are really tied to how the insurance company is doing financially and like current interest rates.
Exactly. With CAWL policies, both your premiums and how fast your cash value grows are affected by like what the insurance company thinks about death rates, investment returns, and their operating costs. If those assumptions are better than expected, you might see lower premiums, or your cash value could grow faster. But if things aren't so good, your premiums might be higher. Usually there's a cap, though. There's a guaranteed maximum. They also mention a partial surrender provision in some CAWL policies that lets you take out some of the cash value without surrender charges or taxes on the interest. There are also low premium and high premium types of CAWL, different approaches to funding and cash value.
Man, we are covering a lot of ground here. Okay, next up is indexed whole life insurance. I'm assuming this is about keeping up with inflation.
That's the goal. They want the policy's face amount to increase, usually tied to something like the CPI, helps maintain its purchasing power. And there are different ways to structure these, depending on who's taking on the inflation risk, the policy owner or the insurance company.
And finally, in non-traditional whole life, we have equity index whole life. Sounds like it could be linked to the stock market for cash value growth, but with some like downside protection.
Exactly. It credits interest to the cash value based on like the growth of a stock market index.
Yeah.
It could be the S&P 500, something like that. But it usually has a guaranteed minimum interest rate. So you have a chance for higher growth linked to the stock market. But you're not directly exposed to losses if the market drops below that guaranteed minimum.
Okay, we've made it through whole life. Now we're getting into alternative non-traditional life insurance products.
Yeah.
The first one is adjustable life. And this one sounds like the policy owner has a lot of control.
It does. Adjustable life is designed to be really flexible. It's kind of like a combination of whole and term life. You can adjust the death benefit, your premiums, as your needs change. They call it the adjustment provision. Just remember, if you want to increase the death benefit, you'll probably have to prove you're still insurable.
Okay, and then there's universal life, also very flexible. And they emphasize this unbundled premium thing. So what does that mean for the policyholder?
Well, with universal life, you have a lot of flexibility in like when you pay premiums, how much you pay, and you can adjust the death benefit too. The unbundled premium means you see exactly where your money's going, like how much goes towards the insurance protection, how much is for expenses, and how much goes to the cash value. And that cash value grows based on current interest rates. Usually there's a minimum guaranteed rate. And a lot of times you can take partial withdrawals from the cash value. They also explain the two main death benefit options. Option A is a level death benefit. Option B is an increasing death benefit, face amount plus the cash value. There's also the tax corridor requirement, which is just there to make sure the policy stays classified as life insurance for tax purposes. And then you've got riders like the waiver of monthly deduction and the no lapse guarantee, and different models like indexed universal life and guaranteed universal life.
All right, so now we're getting into a different area where the SEC regulates the policies, which means these have some kind of investment aspect.
Yeah, these are your variable insurance products.
Yeah.
And because they involve investing in securities, agents need to have both a life insurance license and a securities license to sell them. FINRA, the Financial Industry Regulatory Authority, also helps regulate these products to protect investors.
First up, variable life, or VL. It's got fixed premiums, a guaranteed minimum death benefit, but that cash value is invested in separate accounts, and it can go up or down based on how those investments do. So the policyholder takes the risk, right?
Exactly. It's like a whole life policy, but the cash value is invested in separate accounts, which could hold stocks, bonds, different things. There's a guaranteed minimum death benefit, but the actual death benefit can be higher if those investments do well. But, and this is important, there's no guarantee on the cash value. It depends on those investments, so yeah, the policy owner takes on that risk.
And then there's variable universal life, VUL. It's kind of a mix of variable life and universal life, right?
Yeah, it's a hybrid. You get the flexible premium payments of universal life and the ability to invest in those separate accounts from variable life. So you have flexibility with premiums, control over your investments, And like variable life, there's a guaranteed minimum death benefit. But the cash value is not guaranteed. It all depends on how your investments do.
Okay, almost done here. We're in the home stretch. We're moving on to special use life insurance products, and these are tailored for really specific needs. First up, family joint life policies. They also call them first to die policies. So who are these for?
These are designed to cover multiple people, usually family members. It all pays out when the first person dies. And the survivors can often buy individual policies later without proving insurability. It's often cheaper than buying everyone's separate policies.
Okay, then there are joint life and survivor policies, second to die or survivorship life policies. So the opposite of first to die. What are these mainly used for?
You got it. These cover more than one person, but it doesn't pay out until the last person dies. A lot of times these are used for estate planning, like to pay estate taxes or to make sure assets can be passed on without that tax burden. And because it waits for this second death, the premiums are often lower.
We also have family plan policies. These are the ones that cover like the whole family under one policy, right?
Yep. Usually it's whole life on the main insured and then term riders on the spouse and kids. The good thing is the kids can convert to permanent insurance later, no medical exam needed. And usually you can add new kids to the policy automatically. No extra cost, up to a certain limit.
Okay, then we have family income policies. I'm guessing these provide like a regular income to the beneficiaries, not just a lump sum.
You got it. It's a mix of whole life and a decreasing term rider. So if the insured passes away within a certain period, the beneficiaries get a monthly income for the rest of that period. And then they also get the face value of the whole life policy. So it's immediate income replacement and a lump sum later.
And then family maintenance policies. Sounds similar to family income, but maybe with a different kind of term component.
Right. The difference is the type of term insurance. Family income uses decreasing term. Family maintenance uses level term. So if the insured dies during the term, the beneficiary gets a monthly income for a set period, but it starts from when they died and lasts for the full term. And then at the end of that period, they get the face value of the whole life policy.
Okay, next is juvenile insurance. These are policies for kids. Why do people buy these?
Well, usually an adult buys them. Could be a parent, grandparent, and there are a few reasons. Sometimes it's for like final expenses, but those policies are usually small. A bigger reason is to protect the child's insurability. You buy a policy while they're young and healthy, so they're guaranteed to get coverage later, even if their health changes. There's also this thing called jumping juvenile insurance, sometimes called an estate builder policy. The face amount goes way up, like 5 times higher when the kid reaches a certain age. No new underwriting, no extra premiums.
Okay, getting close to the end here. Next, we have endowments. Sounds like these have a living benefit, which is different.
Yeah, endowments mature at a specific date, and that date is before age 100. So if you're still alive on that date, you get the face amount as a living benefit. If you die before, the beneficiary gets it. But these aren't as common anymore because tax laws changed and they're not as good for saving money. There are also semi-endowments, pure endowments, and juvenile endowments, all a little different.
And then there are modified endowment contracts, or MECs. This is like a tax thing, right? For certain life insurance policies that are overfunded.
Exactly. An MEC is basically a life insurance policy that doesn't follow the IRS funding rules. They call it the 7-pay test. This usually happens when you pay too much in premiums early on. And the problem with being an MEC is that you lose some of the tax benefits of life insurance. So, like distributions, including loans, are taxed differently. It's LIFO, last in, first out. So gains are taxed as ordinary income. And if you take money out before age 59 and a half, there might be a penalty. And all single premium whole life policies are automatically considered MECs.
Okay, there's also industrial or home service life insurance. This sounds like a really old school way of doing things.
It is. It's usually for small amounts, like just enough for burial expenses. And the agent comes to your house to collect the premiums every week or month. There's a newer version, monthly debit ordinary life insurance. It's kind of hybrid. Larger face amounts, and they usually collect premiums monthly.
All right, and finally, we have a bunch of other things here. Face amount plus cash value policies. They pay out both when you die, but the premiums are really high. Accidental death and dismemberment insurance, AD&D, non-medical life insurance, minimum deposit life insurance, the difference between participating and non-participating policies. And then, importantly, stranger-owned life insurance, still lie, and investor-owned life insurance, ILLI. Those are basically scams.
Right. Those last points are all more specialized stuff. And it's really important to understand that STOLI and IOLI are illegal. You have to have an insurable interest to buy a life insurance policy. There has to be like a genuine financial relationship or the expectation of a loss if the insured passes away. And the difference between participating and non-participating policies is important too. Participating policies are usually from mutual companies and they might pay dividends. Non-participating policies are usually from stock companies.
Wow, that was a lot. So many different types of life insurance. It's incredible how many ways there are to like protect yourself and your loved ones financially.
Yeah, and the takeaway is that each policy is designed for specific situations, specific needs. There's no one right answer for everyone.
So, as you're thinking about everything we talked about, term life, whole life, universal, variable, all the special ones in between, think about this. What's the one question you need to ask yourself to figure out what kind of policy or combination of policies is right for you? What are your goals? Your risk tolerance? Maybe it's about how long you need coverage, or if cash value is important to you. Maybe it's about how comfortable you are with investing, or what financial obligations you need to cover. Whatever it is, it's worth taking some time to really consider what makes sense for your situation based on everything we've talked about today.